Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the iShares Trust. It's the Russell 2000 ETF, ticker symbol IWM. As I zoom in here, you'll see that the lines that I drew on the chart last week as my forecast lines are still in place. It's what I usually do from week to week. Leave the lines on there to see how the forecast worked out. And last Friday was right here where I started that line saying we'll most likely drop to test this support level, and I drew that horizontal support level. That still is in place, by the way. And then I said from there we'll most likely bounce. Now we're in more or less the halfway mark here, and I'm going to leave this line exactly as it is, leaving it right there in place with my upside target still intact right there at 202.80. And the reason I'm leaving it there is because if you look right here, this high is a resistance high now. Now remember, that started on Wednesday after we had the big sell-off on Monday, the bounce back, bullish engulfing candle right there. Then we hit the high on Wednesday. So that is now going to act as a resistance line. And as long as the price stays below this 20-period moving average down here, what's going to happen is the 20-period moving average is going to converge in on the price. So by the time this market rallies back up to that resistance, the moving average is also going to act more or less as a double resistance. So early on, I'm calling for an upside move in the markets right across the board, but you really have to keep an eye on that resistance area right there from the highs on Wednesday, which is exactly 203.55. Now, in addition to this, not only do we have a candle that looks very much like a hammer candle, it's doubling as a bullish harami on higher volume. So we had this green candle, volume is increasing on the way up. What I find most interesting, if you recall from the report last week, is that while this was Friday, I said what we have to look for is a drop in volume early in the week. And I did this volume forecast. It's kind of funny, but it's almost exactly at this volume bar where I said we would get a volume drop. Remember, a volume drop on the way down is bullish, and then when the volume starts increasing on the way up, that adds to the bullishness. And again, I'm talking short term only. Longer term, well, I'll get into that in a little bit when we talk about the Qs. Now, looking at the diamonds, ticker symbol DIA, you'll see that we have a similar price move occurring. And from the forecast last week, I said we would most likely drop. Again, it was pretty much the same all across the board. I said we would most likely drop, test this support level. Remember, this candle had not yet been on the chart. I was going from this candle on Friday. And look at that. It bounced right off of support and is now continuing to rally. This, too, is a bullish candle, very close to a bullish engulfing. But I'm leaving this target in place as well. It's not a far stretch to the upside, but I'm keeping that upside target on the chart right there at 348.70. We came very close to hitting that on Wednesday. I think we were shy by 70 cents, but I think we're going to hit that. And the main reason I think we're going to hit that and then start to turn down is because of this right here. See that low? That low matches up perfectly with these highs. And you might have heard me talk about roll reversal. Roll reversal is when you have a support level here that is broken, it then turns to resistance. The opposite is true when a stock or a market breaks out over resistance. Once it breaks out over resistance, the resistance turns to support. So again, I'm keeping those forecast lines in place, not moving them one bit. Now let's talk about the Qs. I'll spend a little bit more time on this one. Here's my forecast lines again for the Qs. We did hit my upside target. Said we would go down, pivot. It's exactly what's happening. Keeping this upside target right here at 356.64. And look down below. We have the oscillators crossing with buy signals. See that? CCI crossing with a buy signal. Yesterday, Thursday, right here, we had a drop in volume on the way down. That is bullish because the selling pressure was being relieved at that point. And now we have an increase on this green candle telling us the buyers have taken over. Now, why am I going to spend a little bit more time on this? Because while I do believe we're going to see a rally, I'm going to show you something on a chart that I normally don't talk about, and I'm moving into 4 different moving averages on the same chart. Take a look at what we're seeing here. This blue line is the 20-period moving average. Now let me zoom in just a little bit more. That blue line representing the 20-period moving average is turning aggressively lower. And while the price stays down at these levels, all of these moving averages, the 20, the 100, the 50, and even the 200, is going to be drawn down because they're lagging, right? They're moving averages. They're not leading the price. The price is leading the moving average. And so while the price is staying down below this 200-period moving average, what will happen? Well, ultimately, if the price does stay below that, and this 200-day moving average acts as resistance, what will happen is ultimately all of these other moving averages will wind up crossing the 200, and now you have computer program selling start to kick in. We saw that early on. There's different algorithms, of course, but when the 20, again, that blue line crosses the 50, for instance, it triggers sell orders into the market. You see that? Then what happened? The 20-period moving average crossed the 100-day moving average. And what do we see? Boom, selling into the market again. So we might drift up again. Have a short-term price target on the upside, but ultimately the market, especially the Qs, are going to hit with heavy, heavy resistance. Now I'm going to go off on a quick tangent because on my Twitter page, I have this link pinned to the top. And this is basically the breadth of the market, right? We have the New York Stock Exchange here showing 52-week highs as they compare 52-week lows. Look at this. New York Stock Exchange, we had 10 stocks hit 52-week highs. That's it, 10. Look to the downside, 542 to the downside. And you think that's bad? Look at what happened in Nasdaq right here. We had 22 stocks hit 52-week highs. And while you think that's good, take a look at the 52-week lows, 1,164. This is off the charts negative. Now, even with this report, as we see it today, I still think we're going to see a quick rally early in the week only, short covering perhaps, maybe some option trading, but ultimately, I think it's lights out. And therefore, I am officially calling the end of the bull market. Why? One more look at the monthly chart. And let me explain this to you. I know I'm taking a little bit more time, but it's important. Back here, all the way back in 2000, this was the high back in 2000. See that? I'm on record for calling the topping pattern right there on that little red, it's called the hanging man. I called the topping pattern just like I did on May 20th for the IWM and on September 24th for the rest of the markets. I called the topping pattern, not a high. And boy, did I catch some heck in the following months, the 2 months after that. But here's my main point. When we went into this 3-year bear market in tech, how long do you think it took before we got back up to those highs? Well, the answer for that is easy. Just look to the right of the chart. It took 16 years to reach that high. 16 years. Now, in comparison, if we get the crash that I do expect to see in tech and beyond, it could actually take longer than that to get back up to these highs. So I am officially calling the end of the bull market. I know I'm going to get a lot of friction on that, but I'm going to call it. I'm going on record today, the 28th of January. We have one more trading day left in January, and as I see it, this red candle is going to stand. There's no way that's going to turn green anytime in one day. Not happening. So as I mentioned to a couple of our coaching clients, if you take the 3 longest red candles over the past 25 years, again, this is 25 years of history, you take the 3 longest, add them all up and make it into one red candle, it's still not longer than what we see in January. That's how significant that red candle is for January. And as they say, as January goes, so goes the year. We'll have to see if that's true. But again, keep your stops in place and don't be afraid to move to cash and protect yourself, because this is a market that's going to require extreme risk management disciplines. Now, that's the end of the Qs. Again, my forecast is still in place right there at 356.64. Keeping that in place. Let's look at the VIX. VIX, this is a leading indicator. My lines for the forecast from last week is still in place. Said we would go up and then come down. Look at that. The downside target on the VIX is 26.88. We had this long shadow up here. See that? On Monday. Now remember, none of these candles were here when I drew these lines. We had that long shadow on top on Monday, and then the VIX started to pivot lower. I'm actually going to go just a little bit lower on the VIX for next week on Monday and Tuesday right here. I think the VIX could drop to 25.32. Then guess what? We have a role reversal support level right here. See that? That will couple with the 20-period moving average as support. Remember, when resistance is broken, here's resistance. When it is broken, it turns to support. Right? Now remember, for the most part, the VIX is inversely related to the S&P. So if I'm thinking the VIX is going to go down a little bit more Monday and Tuesday, that means the S&P could most likely rally, and I'm going to get to that next. So again, for you option traders, this should be music to your ears because this is going to allow you another opportunity to get into some of those long-term calendar spreads and reposition yourself for the next downturn in the market. All right, so that's VIX. If I look at the SPY, again, my lines from last week are still in place. Look what we have here. Isn't that interesting? We had a gap fill support level that was filled right there on Monday, long shadow. I said we would go down to test that and fill that gap. We did exactly that, right? Now what do we have? We have just a hair away from hitting that upside target of 444.78. And I think we're going to go just a little bit beyond that on Monday and Tuesday. Not much, but just a little bit beyond. So I'm extending that upside target of 446.75. Volume is increasing on the way up after a drop in volume yesterday on the way down. Oscillators down below are crossing with buy signals here and here. We have a wide divergence from the moving average. Don't think we're going to get anywhere close to that in the near term. But again, another lesson on risk management. Why? Because if the spiders close below this low or even this low down here below 420, I think it's going to be lights out for a while. These are the highs I think are going to take a long time to see again. But with that, remember that you can make money on the way down. So that's it for this week's market report. Hope you enjoyed that. Please make sure you like, share, subscribe, hit the notification button. You know what to do there, because when you share this video, you're more or less becoming an ambassador to technical analysis. The more people that know about this, the more accurate these charts get and the more money we'll make down the road. So with that, have a great weekend. Talk to you next week. So long.